Mr. Shah, good morning. Thanks so much for joining in. What are your thoughts? I mean, does this look like a market which will reward investors if you have a medium to a long-term view? Or do you think that there is ample reason for some bit of a correction, either due to valuations or due to liquidity or due to a lot of issues hitting the market in the primary side, for the markets to correct that V little bit?
Firstly, in every market in India and of course elsewhere in the world, selective buying, well-researched buying has always paid off. And I think even in this market, which is at its historic highs in terms of price earning multiples and so on, you still see pockets of outperformance possibilities in companies as their profits improve, as they come out with products or capacities or marketing business models which are different and better, and then they outperform their competitors. Having said that, there are lots of reasons for caution now, and we see that in the global press very clearly, a little bit in the Indian press. In India, just remember that in June, July, August, September, we've had 7,000, 12,000, 19,000 and 18,000 crore rupees flow into plain equity funds alone. In addition, there's money going into balanced funds, which are 65%, as you know, invested in equities. So a lot of money is flowing into equities. So there's a lot of pressure on these mutual fund managers to deploy that money. Some are taking cautious stands, holding back and buying when they see value, but others get carried away with momentum buying. That's why you see these big run-ups and this big volatility when there's marginal outperformance. Commodity businesses are doing extremely well, partly, of course, because the global cycle, US, UK, Europe and Japan are seeing an improvement in their economies. But the other signs of caution are pretty evident. You saw the Deutsche Bank report, which talks of several possible trigger points. The most important, I think, is this calibration of interest rate rises in the United States, accompanied by reduction in the Fed balance sheet size. That can pull a lot of money out, and if the calibration is not done right, you can see a lot of hiccups in the market, a big correction. And of course, if interest rates rise, the US dollar will strengthen. And one of the reasons why the US is doing well is that the dollar has fallen so badly. Then we've had the Chinese central bank governor, who's now leaving, but he blurted out the Minsky moment concept. He said there is a possibility of a Minsky moment, and this is where everyone gets worried that if China is talking of an asset price correction, a sudden correction from something latent and visible or hidden, we must sort of be cautious. So there are reasons to worry.
And are you worried then? My question to you simply would be, what kind of chips are you taking off the table? I mean, is it a percentage of your portfolio? Are you skimming profits where you've made? What is it that you're doing?
Absolutely. I think where you see multiples, you know, I'm just giving example, Indraprastha Gas and so on, we've done extremely well, very good company, but you see it at multiples and prices which are going high, then you like to sort of think about taking off some money from those kinds of scripts where you've done extremely well. Your target price has been overshot substantially. So certainly that will continue. All the asset managers will be probably looking at their portfolio for trimming and cropping some of the gains and gathering them and recycling them, because irrational exuberance can continue for a long time. We saw it in several cycles in India and abroad, and so one cannot stay out of the market, because then there would be underperformance. So you have to be in the market, but you must from time to time crop gains when one sees that the target price have been met or gone beyond.
Okay, Mr. Shah, the other question is that while we may, and it remains a big question mark, but we may see some bit of outflows, and we're not immune to that. I mean, the last 2 months, if anything, we've seen enough and more FI outflows, but well compensated by the domestic liquidity, which seems to be here to stay. At least the SIP money seems to be here to stay, and that's about $1 billion odd coming in every month. Will that compensate, Or do you presume that if indeed there is substantially more outflows, and what's the probability of that in the first place is what I want to ask you, but if there are some FI outflows meaningfully larger than what we've seen already, is there a case for a correction?
I don't think the correction will come only from outflows. The correction will come from mindset changes. You know, if a global event takes place, a North Korea, US blow up, or something on interest rates, which is very unsettling. Or for instance, as Steve Mnuchin pointed out in the United States, if the tax proposals do not go through or go below the expectations of the market and a dramatic drop takes place in Western markets. You remember 1987 when there was a 20% drop in values overnight with no major trigger, as it were. That kind of thing can unsettle markets globally, worldwide, including in India, because we are all interconnected at the end of the day. So that global event development is probably, in my mind, the highest risk. And then there can be political developments in India. We saw demonetization, how it suddenly and unexpectedly it struck the Indian markets. And then we've had GST, which was planned, but its implementation is causing some concern from time to time, and job losses and so on. So these kinds of triggers, if there is a political decision which affects markets dramatically, you can see a major change in sentiment, and then that sentiment gets translated into prices and so on.
Okay, Mr. Shah, this market is kind of bipolar, and let me define my question. And different people use bipolar in a different way. What I mean to say is that, one, we've got extreme preference for quality names, and therefore the multiples are substantially high out there. But there is also this other side which is starting to brew, wherein people are buying into fractured, not really broken, but fractured balance sheets or fractured business cycles which are trying to make a bit of a comeback. We've seen that happening in steel, we've seen that happening in real estate companies or housing companies as well. What do you think wins the battle over the course of the next 6 to 12 odd months? And where are you fishing, if at all you are fishing right now?
You hit the nail on the head. Some of these investments in some of these fractured companies which have potential for revival, but in different forms, just the assets may get transferred, not the company, and so on. They seem to be, to me, far too speculative for an investment manager that's looking for value proposition, that is a principled approach to buying into equities. This is very iffy and event-based, and so I would say that if the resolution of a company under the Insolvency Act comes out right for the existing shareholders, wonderful, the shareholders will do very well. But if the assets get sold and the company remains a shell and some buyer takes it over, I mean that may not really help existing investors. So it is too iffy to my mind, and the events have not played out as predictably as we would like to see, because the law is very new, the insolvency law. So there have been not many precedents as to say how the existing investors will fare out of it. So I would be very hesitant to buy. I would much rather go for the straight approach of buying value stake picks on the basis of good managements, their growth prospects of their companies, and based on products, markets, positioning, pricing, etc. And of course, there will be some exuberance in some of these sectors where we can predict that India's consumption demand will go up. So you see these consumer stocks doing so well. For outperformance, it may not be wise to buy at 50 multiples of earnings, and it may be better to go for the under-researched mid-cap stocks, and not necessarily only in the consumer space. There are so many other sectors. I mean, you see the power sector now, whether a power sector play has to be in the generation or the distribution, which are very capital intensive, or in some other component area. That is a call that the asset manager can take and search out stocks. There's in every area, there is that possibility to make money by identifying under-researched companies which are doing well, they're good business and robust business models and excellent managements.
So what would you be advising your fund management team to do? Let's take the example of power, since you mentioned it's a wide pocket, fractured balance sheets. Selectively, power distribution, etc. has done well, but the generation companies haven't, and maybe that's why they are available at the valuations that they are. Where can an average investor take take exposure, if at all? What would you be advising your team to do?
So you've seen, I'm just giving examples, the KECs of the world and the Kalpatarus of the world, they supply power transmission towers, and of course there are component manufacturers, whether it's transformers and electricals and switch gears and so on, or meters and so on. As for instance, this solar or renewable energy push takes place, then there will be a change. You will need smart meters, you will need smart grids. Are there people who can supply those kinds of things? Is there then a value proposition though? That's the way I would look at that sector. It is not obvious to me that people will make money from generation businesses which are large, capital intensive. There's also the threat from these renewables which can be put up very quickly and in large capacity, and then the government's policy of allowing renewables to eat into the base load power stations markets. And we saw what happened in Germany, for instance. The RWEs and EONs suffered very badly as renewables took up 24% of the market, and renewables are not baseload stations. So this is something which one has to think of. Where will the money be made if regulations change, and especially in industries which are very heavily dependent on regulations? Look at pharma industry. Pharma, I mean, logic is the logical argument that demand will continue to grow is very sound. But then if regulations come in and put price controls and disclosure of costs and generic and then other elements such as those elimination of fixed dose combination and so on, you can disrupt the industry quite dramatically and disrupt value for shareholders quite dramatically. I think the government exported through its policies our whole API, the active pharmaceutical ingredient market, to China. Now, if you have to bring it back, you may have to relax on price control. You may have to make concessions. Now, does the government recognize this? And if it can make concession with one stroke of a pen, can it take away those concessions at another stroke of the pen? These are issues which will remain in that industry, for instance, for times to come. So one has to take a call how companies are addressing it. And you see Indian companies addressing it through export markets and diversified export markets and a range of therapeutic areas that they cover and so on. And some going also into OTC products which are not under price control, whereas some of the multinationals are very, they go only for ethical products and research-based products and so on and so forth, and they can be hit by these regulatory changes much more.
Okay, Mr. Shah, final question really. You've seen multiple cycles. In the current cycle, which is that performing pocket which you reckon could continue doing that? I think the simple answer is NBFC, but within that, there are probably a bunch of pockets which are overvalued as well. But what do you think is here to stay and make money for investors over the course of the next maybe 4 or 5 years or more?
NBFC, yeah. So I think even in NBFCs, you have to be cautious and careful. All these proposals, there's a big fad going on that you can lend and small loans without unsecured on the basis of just data analytics and your money will come back. I think the cycle is not played out. So one has to be careful and cautious. We saw one hiccup once when the regulators struck in Andhra Pradesh and so on, and how companies got affected. But without even regulatory intervention, there can be just market-based risks in those companies. But generally, yes, the good banks can do very well, and we've seen the HDFC as a classic example of years of outperformance. And then we see consumer products companies, well-established brands, local names as well as international multinational companies with their multinational portfolios addressing consumer needs with Indianized tastes or Indianized touches. Those will continue to do well. At what price to buy for outperformance? It's a different call. But certainly, those companies will do well, and their share prices will reflect that performance.
Okay. We'll leave it at that. Mr. Shah, thanks so much for taking the time out and joining us today. Look forward to have you more often on this forum.
Pleasure.